Hello, I'm Robert, and welcome to my channel, where I talk about everything automated algorithmic trading, or simply algo trading. Today I am back with another follow-up of the 20 pip challenge, and I'm going to beat a few dead horses along the way. So let's really get into this and talk about why am I beating dead horses and what is so important about this challenge that stands out. Well, let's start off with the challenge itself. One of the biggest things I see in trading is people don't take the time to thoroughly test a strategy. You cannot, under any circumstances, expect to make money in the market if you don't have a thorough understanding of the strategy you are trading. You must have a minimum of 100 completed trades, or what I call a trade cycle, in order to gauge whether or not your strategy is reasonably successful. That's the first major consideration. Second, you cannot, under any circumstances, take a back test and go straight into testing and trading with live money and expect it to go well. Live markets are never, ever a good thing to do straight off of a back test. I can promise you and guarantee you, you are going to lose a lot of money doing that. You must go through the process of a forward test, always. If you don't, it never ends well. And that is really the reason why I am beating these dead horses. Because time and time again, I see people taking large amounts of money, putting them into a trading system that they've back tested and it was miraculously profitable, only to literally lose 75 to 90% of it very quickly. The process for algorithmic trading, and this is the same process even if you aren't using a machine to do it for you. You must back test. Then you must forward test. Then and only then, if both the back test and the forward test show a meaningful profit, then you move to a small amount in a live account. It is important to really understand that starting small is critical. If you come into trading a live account and put down $10,000 positions, you're going to be decimated. Whereas if you put down and trade the smallest positions possible in a live account to gauge how well your strategy is working, then your risks are going to be extremely minimal. It is always better to learn on small values that you can reclaim easily than catastrophic losses. There is a reason for this, and it's more than just testing your algorithm or your strategy. When you get to a certain point in a market, any market, the size of your positions begin to collapse because you don't have the liquidity in the market to support large positions. Not all markets scale well. That is, a market that might work at 10 units per position might be totally disastrous at 100 units per position. You have to follow a slow, consistent, methodical process. Step by step. 1, 2, 3. That is the only way to gauge the true value and success of a strategy. So before you've ever entered into the live market, you should have 200 trades. 100 back tests, 100 forward tests to determine the validity of the strategy. In doing so, you have gained a thorough understanding of the strategy. You know how it works enough that should something go wrong, you can manually intervene to correct it. Machines do break. Internet connections get disrupted, so forth. Understanding these help you stay profitable. The next point of beating these horses is you have to realize profits don't come quickly. A year from now, 2 years from now, somebody's going to come to these videos and be able to watch them back to back. They're going to miss the critical point of how long this process takes. This process is not a hurry up, let's get it done so we can go make money. That is not the right way to think about the process. This process is take your time, get it right, learn the truth about the strategy. Will it work or won't it work? You must make the effort at all times under all circumstances to be as methodical as you can be. Having mistakes with play money or paper money is fine. You can blow the account up 100 times over and there's no consequence. But as soon as you move to your money, it's a whole different situation, and the consequences become real and permanent. The 20 pip challenge is a wonderful little tool to learn from because it offers so many lessons. It teaches you probability and statistics between win rates and loss rates. You can see realistically how many times you're going to lose versus how many times you're going to win. You can calculate a meaningful representation of the amount of wins versus losses. It teaches also consistency, and that is when you take losses, and you will take losses, what is the consistency between the number of losses you take versus the number of winning trades you take? How well does the strategy protect your budget? That is the most critical part of trading. You must protect your budget. If you don't, you're not going to be trading for very long because you're going to be wiped out. We can see from the 86 trades that this strategy is doing well. It's doing exactly what it is supposed to be doing for a stop-loss strategy. It is brilliantly and meticulously protecting against catastrophic loss. It has a very strong and durable risk management process. It has a strong and solid technical process. Those are all absolutely critical points you must pay attention to. Your strategy must be solid in its technical approach. It must be solid in its fundamental protections of your budget. It must be solid in how it manages the market. Only then, through actually analyzing the strategy over a minimum of 100 trades, can you genuinely see how well that strategy is going to work. Keep in mind that the average investor or trader only makes 1 to 3% of their entire budget in profit per year. That is the regular, standard, normal assessment for trading. 1 to 3% per year. So on a balance of $100, a normal profit level for that year is going to be $1. and that is specific to a stop loss strategy. Accumulation strategies work different because they try not to take any losses at all, and rather they focus on entry points to accumulate over time. They have their own set of rules and their own set of risks. One is not better than the other. It is simply a different mindset and a different technique to help an individual get a proper footing in the market. There is no such thing as a perfect trade or a perfect strategy. They don't exist. What matters is consistency through aggregation. Your ability to profit over a period of time consistently is what will determine whether or not you are a successful trader. Now, that's not to say that every single trading approach is going to make money, because they're not. That is the whole point of the back test and forward test, to find out which ones will and which ones won't, and to do so in a way that doesn't touch your real money. By the time you're ready to move to a live account, you should have a clear and concise, focused approach that you know makes money. You know in the long term will be successful. You know you're not going to be laying awake at night worrying about what happens if the market goes completely opposite of whatever position you're holding, because you know your strategy will be capable of managing the risks appropriate. All of these things are absolutely important to pay attention to. Missing any of them, and you will be part of the 90% of people that have lost 90% of their money in the first 90 days of trading. Risk management is your first step. Finding a consistency within the market is your second step. Only after you've managed not to lose your money can you then begin focusing on actually making money. I cannot emphasize this enough. The strategies you trade are critical to each of these steps. In order for you to gain a successful long-term consistency. Now, as we can see, this strategy is doing well. It's brilliant. It's beautiful. It is one of the best on the market because it does everything the way it is supposed to do. You're not going to make $1 million off of it. You're not even going to make $10,000 off of it overnight. Over time, it will produce reliable, resilient, consistent profits. But those profits are going to be on the basis of the statistical probabilities of what the stop loss is actually capable of doing. And we see how that works here on the trades themselves. When we actually look at all of the balances, and we see them going up and going down, but hovering very consistently within a very specific point of reference. This is how you make money in trading for a stop loss technique. Now we are going to talk about the same strategy, but instead of a stop loss technique, we're going to use an accumulation style. That is, instead of getting out of the market at 15 pip intervals when the market is moving against us, we're going to buy a second or third position. This is, in of itself, a different mindset. Not better, not worse. But it goes through the ability of risk at a different level. Here we're looking at the British pound USD. but it can be any pair in the market. It doesn't matter. It's still a 20 pip challenge because of the way it works. 20 pips take profit, 15 pips deviation. Or for cryptocurrencies, 2% take profit, 1.5% deviation. Basically the 4/3 principle. So as we look at this, we see 24 days, 16 completed trade cycles. This is going to be a long forward test. Basically 16 trades a month. You must go through 100 forward testing trades. Absolutely. Now you can use different assets to get that way for your back testing. But your forward testing must be brutal and long-suffering. Do not take shortcuts on your forward testing, even when you have results this promising. Take your time. Study the market. If you want to speed up your forward testing a little bit more, then test multiple assets simultaneously through multiple markets. That way you can get the trades you're looking for as an aggregated context. But you'll need to be aware that every market has its own limits and its own restrictions. So in this case, this market has taken on 26 individual positions, and it's only made 8 successful trades, which is fine. Nothing wrong with that. But when you're looking at aggregated results like this, make sure you understand worst case scenario planning. And this holds true no matter what. All trading must have a worst case scenario plan. That way, when you're laying in bed at night sleeping, you're not worried about the market doing what this one did for the Hong Kong dollar Japanese yen, going completely against it in a most horrible and brutal way. You've already planned out your worst case scenario. You already know what that is going to be and how bad that can get. That is really the most critical part of your risk management process. What can happen if things really go against you horribly wrong? Understand them. Focus on them. Look at how everything connects together. Trading is a series of steps. It is a process, a methodology. And that methodology must be consistent in order for you to make consistent profits. Now, this chart is based upon Jackrabbit TV, but it doesn't matter really what approach you use, as long as you start with consistency, as long as you test appropriate every single circumstance, as long as you don't take shortcuts in your trading. Bull markets are wonderful because no matter how bad your strategy is, it will make money. Bear markets are where you actually get tested because anything and everything that can go wrong with your strategy will. Whether it's taking on too many accumulations or being stopped out too frequently because a harvester is looking to cannibalize you. It doesn't matter. Bear markets are what really test your strategy. They are the ones that really give you a good outlook because they are the ones that are always going against whatever your strategy is. Always focus on the analysis. Take your time. Don't rush the process. I am going to continue running the 20 pip challenge. and we're going to complete this analysis before we actually move on in terms of learning more Python code. You must have that footprint. You must have that level of patience and algorithmic trading to be able to understand and survive the market. It's a slow, tedious process, and it's not going to be glamorous ever. If you can't survive waiting for the data to collect and results to be analyzed, you're not going to make money consistently. You're not going to be profitable in a long term. You must think about these conditions carefully. And no, I'm not done beating this dead horse. At least not in the long term. Over time, 6 months from now, 3 months from now, I'll probably beat it again. Because I see so many people that are in such a big rush to get into the market that they don't take the proper steps to really trade right. Every market has opportunities, and every market is a recipe for ruin. The only difference between one and the other is you, the individual behind the machine. No AI is ever going to just magically make you rich. The markets change too quickly, they're too dynamic. The whole secret of being profitable is not the machine. It's your ability to think about and manage your risk. That is the ultimate true edge of trading. So, if you like this video, please give it a thumbs up. It really does help the YouTube algorithm. Leave questions in the comments if you have any. Most importantly, have fun trading. Don't get caught up thinking you're going to miss out on the next great move. You're not. If anything, you're going to miss out on the next great price dump. And this is a good example of somebody who thought they were getting in at a great deal, and then the market just ripped them in an unrighteous manner. Take the time. This is an example of trading that worked well, and it was profitable only because time was taken to study the market, analyze the strategy, understand the strategy, backtest the strategy, and now currently forward testing the strategy in a meaningful, consistent, and reliable way with processes built on a scientific and mathematical model. You don't need to be a PhD to make money, but you do need to take your time. Thank you for watching, and until next time.